My name is Antoine Martin, and I am a vice president here at the Federal Reserve Bank of New York, and I'm head of the Money and Payment Studies function. So the title of my presentation is Monetary Policy Implementation with a Large Central Bank Balance Sheet. Since 2008, first because of the crisis and the exceptional policy measures that had to be taken to stabilize financial markets at the time, and then since that, through several rounds of quantitative easing, also known as QE, the balance sheet of the Federal Reserve has grown tremendously. The amount of excess reserve that are currently in the system went from being a very, very small amount, measured in tens of billion, to being a huge amount, today almost 2.8 trillion. That means we have a very large balance sheet, and that creates some issues in conducting monetary policy. Without new tools, for example, the authority to pay interest on reserves, IOER, and other tools such as the overnight RRP that have been tested, or the term deposit facility that have also been tested recently, we might find it difficult to lift interest rates where we want to do that. With these tools, however, we have the ability to lift rates when it's the time to do so. One of the questions that came out in the discussion was whether it's going to be expensive for the Federal Reserve to have a very large balance sheet, to have a lot of reserve in the system, and to be paying interest on all these reserves. And I think there's a misconception here that's important to clarify. When we inject reserves in the system, the way we do it is that we purchase assets. And so we have more liabilities, reserves on which we pay interest, but we also have more assets. And typically the assets that we have on our balance sheet earn more than the cost of the liabilities that are backing these assets.